The government of Ghana has announced plans to begin issuance of domestic bonds 3 years after restriction for fresh debt due to the domestic debt exchange program. The Finance Ministry says the expiration of the restrictions paves the way for it to drastically reduce its dependence on treasury bills to finance its budget and allows for the issuance of new, longer dated domestic bonds. Now, technical advisor to the Finance Minister, Dr. Theo Champon, told JoyNews on PM Express that this would allow the government to obtain fresh capital for infrastructure expenditure.
But what is also very interesting is that the decision to pursue this policy is not happening as though you are not doing other interventions. So we're just talking here where I did mention that today the ministry put a statement out, right? And it says that now that the road is almost clear with the post-DDEP, the domestic debt exchange, you can go back to the capital market. You are looking at how you can borrow less from the short end of the market, so less T-bills, and rather now do more medium to long-term, right, instruments. So issue 5-year bonds, issue 10-year bonds. We are the stock and in the budget, the 10 billion, right, bond that the government will be pushing out to help finance roads and other, right, infrastructure projects. So the point I'm really trying to make here is that when you do the social analysis and then you look at the broader context of the other interventions that are being made, right, this is not just like a binary choice. So it's either this or that. You have other things that are being made, and you then do the net analysis to arrive at a position that says, okay, given all the trade-offs that you have to take into account, given the fact that a year or so ago, you would have had some of these goods, right, not passing through the formal financial system, right? You had the people come by, some will be smuggled and all of that, but now you're able to channel that and you're able to use that to support your reserves, your exchange rate, drive down inflation, and all those other things. The net benefit really, for me, sort of far outweighs the relative cost that we're talking about.
Now, I'm thinking about this question in my head, and I'm asking, is this a fiscal policy or a monetary policy?
It's a combination, so think about it, right? So what Gold Board is doing in the past was Bank of Ghana gives you money. It buys gold, supplies the gold to the central bank. The central bank adds it to its reserves and then all of that, okay? Now Gold Board is going to be trading on its own balance sheet, right? So everything it does would now not sit within the realms of the monetary policy side, but rather, right, on the fiscal side. So think about it as to be a bit technical, like a quasi-fiscal, right, operation that straddles both the monetary and the fiscal side of the equation. But the end objective really is that you want to be able to support the reserve accumulation and take advantage of the window of opportunity.
But is the government prepared for this? Professor of Finance at the University of Ghana Business School says the aggressive intervention of the Bank of Ghana in the forest market, coupled with other factors, afforded government the room to make this decision. He spoke on SMS.
Increase in terrorization in terms of mopping up of excess liquidity from the system, and then also the intervention, even the Bank of Ghana would prefer that we call it intermediation, by injecting billions of dollars into the economy, cause the strengthening of the local currency. So in terms of our exposure, market to market of external debt, our total debt in CD terms came down significantly. Now the result of all of that is that they had been preparing for an entry into the bond market.
Well, JoyNews research has been studying the market and conditions for a successful return to the market to borrow. And head of research, Isaac Ofieje, joins me in studio. He's got the details. Now, the question is, has the government met all the conditions, and how prepared are investors?
In terms of conditions being met by government, currently, you know, inflation is around less than 4%. That is massive for government. You look at the treasury bill market, which is a good test for what should happen in the long-term market. Now, treasury bills are going for rates less than 6%. You look at the 91 bill, 180 days, and the 1 year bill, all hovering below, 9% or let's say 7% in terms of the interest rate. That should tell you that that side is fixed. And in terms of other preparation towards creating that fiscal space in terms of how much we owe in terms of our total debt stock, remember Professor Bobkin spoke about the aggressive intervention that the Bank of Ghana did in the forex market, pumping over $10 billion for operations and to meet the demands of the market. That in itself strengthened the cedi, which brought the cedi to the dollar to somewhere around 10 cedis, 25 pesos, or 10 cedis, 70 pesos. And remember that the president said that, well, they were targeting the year-to-date, the annual depreciation rate of maximum 5%. That gave the cedi some strength. And in terms of our external debt, that really wiped away a significant component of our external debt, bringing down total debt to below $700 billion Ghana cedis, creating that big fiscal space for government to step in to borrow. And if you are talking about issuance of local bonds, you needed this kind of breathing space for government to be able to come into the market to borrow. But why is government looking at bonds and not treasury bills? Well, the two are very different. If you are looking at treasury bills, it means that when government borrows from the market, they have maximum a year to pay back that money plus the interest, and that sometimes the turnaround time is very, very small. And so it makes it very difficult for government to make a decision when they take loans or they take money from the short end of the market. But bonds are different. Why? Because usually they range from 2 years, 5 years, 10 years, and some are even able to introduce century bonds. There was a point where even Ghana was talking about a century bond in the Eurobond space, where if government takes this money, they pay the interest of the coupon every 6 months, and after the maturing period of, let's say, 5 years or 10 years, they pay back the principal. So if you look at it, this gives government a very long time to plan around the money they've taken, and that's why they're coming into the market. They've been very strategic. Why do I say so? Because, currently, the prevailing rate in the treasury bill space around below 6%. It means that if government is coming into the market to issue new bonds in terms of local bonds, they can do somewhere around 10% to about 12%, which is relatively below the rates of, let's say, 18% or 19% that they used to charge 2 years or 4 years ago. And imagine T-bill rates being around MFR 30%. And government not driving this down. It simply will mean that when they come into the market to issue local bonds, they would have to price above treasury bills for people to be able to come into the bonds market. Now we have seen that there's oversubscription for treasury bills. Government is no longer taking significant amount of money from the treasury bill market. So there's excess liquidity in the system. And government believes that when they step in with the local bonds with a relatively higher interest rate and not too expensive, investors
will incentivize those who are on the treasury bill.
Incentivize investors to come onto that path. But our check shows that investors are still really being attracted by the short end part of the market because of the fears of what happened in 2023 and 2024. Nobody wants to lock in within a very long period of time. And so if they are diversifying their portfolio... What
would a long period of time look like?
That would mean, let's say, 5 years, 10 years, or 20 years, right? Okay. They no longer want to do that. They want to do very short period, 91 days, 180 days, or maximum a year, and they'll be able to get their money back with the interest, find other alternatives. And because of the uncertainties going around in the global space, nobody wants to lock in their investment for a very long period of time, maybe except gold, right? But if you're talking about liquidity, in terms of liquidity being held in the local currency, I'm not sure that investors would want that long period. But sincerely, there's still huge pension funds, insurance, money from the insurance space, and the banking sector that are looking for some of these opportunities to actually invest. They still believe in government anyway. We've gone a long way from where we used to be 2023. And this alone proves to the market that government is being consistent with its payment in terms of the coupons in the local bonds market. Even after the restructuring, just recently, they paid some 10 billion Ghana cedis in terms of coupon payments in the DDEP space. And that in itself is, sent a positive signal to the market that government is really willing to meet its part of the bargain in terms of payment and its commitment. But the intelligence we are gathering is that investors are still stuck at the short end part of the market. It will take something lucrative or something very sweet to actually attract investors into the long-term part of the market, which will be the local bonds.
Well, but Kofi, I'm just wondering, what will that sweet thing look like?
Definitely.
What kind of offering?
Rate.
The rate?
Let's say 12%, 15%. But would that be too high? We understand that Atoforsen is not really interested in giving too much high interest rate. But what will be his coupon rate for the bonds? We are still looking at it because he's not just coming in to issue bonds for infrastructure. They will be issuing bonds for cocoa as well, cocoa purchases. Yeah. Where will the interest be? How will that interest be different from what, government will issue for cocoa? I remember Dachi bonds and ESLA bonds used to still around 18%, 19%. Definitely, we are not going to go that high. But talking about that sweet interest rate, I simply do not know. It's only this man who knows.
But by the way, Kofi, we definitely know that at least this one will incentivize some investors. Tells you that government is quite committed and truthful. But